The lost decade warning. Is the U.S. market entering a new era? For decades, investors have been conditioned to believe one simple idea: the market always goes up. Buy the dip, stay patient, and over time, you'll be rewarded. But what if that assumption is about to be tested? What if the next decade doesn't look like the last? Today, we're diving into a growing concern among analysts and economists: the possibility that the U.S. stock market could be heading toward a lost decade. To understand this warning, we need to look back at history. The term lost decade became famous after Japan's economic collapse in the early 1990s. After years of explosive growth, Japan's stock market peaked and then stagnated. For nearly 10 years, and arguably longer, investors saw little to no real returns. The market moved sideways. Optimism faded, and what once seemed like unstoppable growth turned into prolonged disappointment. Now, some experts are beginning to ask, could something similar happen in the United States? Let's start with valuations. One of the biggest red flags right now is how expensive stocks appear compared to historical norms. Metrics like price-to-earnings ratios are still elevated, even after periods of volatility. When markets are priced for perfection, even small disappointments, like slower earnings growth or higher interest rates, can lead to years of underperformance instead of quick recoveries. And that brings us to the next issue: interest rates. For over a decade, markets benefited from historically low rates. Cheap money fueled borrowing, investing, and risk-taking. But that era is changing. As rates rise, the cost of capital increases, and suddenly, the same growth stocks that thrived in a low-rate environment start to struggle. This shift alone could reshape how the market behaves over the next 10 years. There's also the question of economic growth. The U.S. economy is still strong compared to many others, but it's not immune to long-term challenges. Slower population growth, rising debt levels, and global competition all play a role. When growth slows, corporate earnings tend to follow. And without strong earnings growth, stock markets have a harder time delivering strong returns. Another key factor is investor expectations. Over the past decade, many people entered the market during one of the greatest bull runs in history. This has created a generation of investors who expect quick gains and consistent rebounds. But if the market enters a prolonged sideways phase, that mindset could be tested. A lost decade isn't just about numbers, it's about psychology. It wears down confidence, patience, and belief in the system. But here's the important part: a lost decade doesn't mean the market crashes and stays down. It often means something more subtle, and in some ways, more frustrating. The market may rise, fall, recover, and repeat, but ultimately go nowhere over a long period. For long-term investors, that can feel like running in place. So, does this mean investors should panic? Not necessarily. History also shows that periods of stagnation can create opportunities. When broad markets struggle, certain sectors, industries, or strategies can still perform well. It becomes less about riding the wave and more about being selective, disciplined, and adaptable. Diversification becomes more important than ever. Instead of relying solely on one market or one type of asset, investors may need to spread risk across different regions, industries, and even asset classes. This could include international stocks, commodities, or alternative investments, areas that might outperform if U.S. markets slow down. There's also a shift toward income-focused investing. In a low-growth environment, dividends and cash flow become more valuable. Companies that consistently generate income and return capital to shareholders may become more attractive than high-growth companies with uncertain futures. And perhaps most importantly, a potential lost decade forces investors to rethink their timelines. If returns are lower, reaching financial goals may take longer. That doesn't mean those goals are out of reach. It just means expectations need to adjust. So, are we definitely heading into a lost decade? The truth is, no one knows for sure. Markets are influenced by countless variables: technology, policy changes, global events, and they have a way of surprising even the most experienced analysts. But the warning itself is worth paying attention to. Because whether or not a lost decade actually happens, the conditions we're seeing today, high valuations, rising rates, and shifting economic dynamics, are very real. And they suggest that the next chapter for the market could look very different from the last. In the end, the key takeaway isn't fear, it's awareness. The era of easy gains may be fading, and a more complex, uncertain environment could be taking its place. For investors, that means staying informed, staying flexible, and most importantly, staying realistic about what the future might hold. Because sometimes, the biggest risk in the market isn't losing money. It's assuming the future will look exactly like the past.